Alrighty guys, so in this video we're going to be going through two things, London session and New York session, discussing ICT concepts. We're going to be talking about rejection blocks, we're going to be talking about fake market structure shifts, and also times when the market just continues in one trend. So sometimes reversals are not the best idea. So let's get into it. Before we start, thanks for those that helped me fix that situation with the magnet. Now I can place things wherever I like, so I really appreciate that. But essentially what I saw here, I didn't trade yesterday myself, was Asian session looking back, right, leading into London session. There's a lot of accumulation, like from 2 o'clock all the way to 3 o'clock. Look at that. So choppy. Those there are not trading conditions. Like we come down, we come up, we come down, we come up, we come down. But what I noticed looking back in hindsight was this. See this initial swing high here? We formed relative equal highs here. Now we know that relative equal highs and lows hold a lot of liquidity, right? So I'm going to mark out here relative equal highs. Look what happens below though. Now you might say to me, okay Ruben, what about this swing low and this swing low? Yes, they're also relative equal lows. And I'm going to talk about the difference between the buy side liquidity and the sell side liquidity, and maybe why you would have been looking for longs here rather than shorts. So we've got relative equal lows and we've got relative equal highs. Which side has the fair value gap? It's the bottom side, right? And which side raids liquidity and then taps into a fair value gap? It's this bottom side. So what I want you to look at is, yes, keep that in mind, but look at the fact that this swing low and this swing low are taken out. Now, when the market does this choppy and accumulation kind of setup, do you know how many people are getting stopped out? People are going short, then they're going long, then they're going short, then they're going long. They're getting stopped out here, stopped out here. So there's a lot of liquidity built up, and that's exactly why you see this massive move after that accumulation. It's like an accumulation and expansion, which is what ICT refers to. But this line here, notice here that we actually raid this swing low and this swing low. This swing low has not been taken out in quite some time. We almost do. This is like a fake move, and then we finally take that out. We take that out with 2 wicks, and then what happens there? We tap into this 3-minute bullish fair value gap. So let me show you that. So essentially, what you want to look for whenever you're trying to see where the market's going to go, whenever liquidity gets taken, if there's an imbalance really close to it, you want to see the reaction or wait for the reaction from that imbalance, because in this case, you can see perfectly. We take out this swing low of this candle and this swing low. Let me get rid of this. And we just tap into that imbalance and we immediately reject on the 3-minute time frame. Now, if you're looking for another confluence that could kind of hint you to going long apart from this, but let me just put this in. It's called a rejection block, and it happens twice yesterday that I can see. Once on a really small time frame and once just on CPI news candle. So I wanted to go through that and talk about that concept as well. So we've got a rate of sell side liquidity here. So if you're trading London Open, I don't see any opportunities here. There's no real opportunities. If you're trading Silver Bullet, well, that's the 3 o'clock candle. Now, I might have mentioned this before in some of my other videos, but I want you to observe for yourself and back test and forward test this. Have a look at the 2 a.m. candle and the 3 a.m. candle. So if you're trading the London session, have a look at these 2 candles and see if they do anything interesting. So sometimes what I notice is that when volatility and volume comes into the market, either at 2 a.m. or 3 a.m., the market might just wick into an area and reject from there. That signifies the true price direction of movement, and it also gives you a little hint. So it was in my video, I believe, yesterday or the day before for my London session trade, and I mentioned that the 2 a.m. candle came down, it tapped into a bearish fair value gap, or a bullish one, sorry, and then rejected straight away. For me, that's a really nice price signature that I use to give me a bit of an idea of where the market's going to go. So I'd encourage you to have a look at those exact candles on the minute, see if they do anything important. The same I've found goes for the 9:30 a.m. candle and the 10 a.m. candle. Right, so there's all these little price signatures. This is never something I've talked about, but it's something I've been observing over the last few weeks and months, and I thought I'd kind of bring it up in this video. So just have a look at that, back test that, forward test that, and if something happens on those candles that fits your idea or fits your bias, then it's a good confirmation for you to enter that trade. So we take out sell side liquidity, which means we've satisfied one thing the market likes to do. We know the market targets liquidity. Plus, we've tapped into this imbalance here, right? As soon as we raid liquidity, what do? We reject. Have we raided liquidity here? Technically, yeah, you've raided this swing high here, but have we tapped into an imbalance? No. what's the overall order flow? Bullish, right? The fact that you've got this imbalance here and the sell side liquidity is stronger than just this here, if you get me. So we rate that sell side. Where are we going to go to next? The buy side. Where could you enter from? That's the question here, right? Couple places, right? Number one, these two candles, look at the wicks on these candles. They're really, really long. What you call that, the lowest candle, it's called a rejection block. So this green candle here, that there is called a rejection block. The candle has to take out sell side liquidity and it has to have a really long wick. Even better if there's two candles that have really long wicks. And ICT mentions this. Now, whenever there's a candle, and I do this all the time on videos, if you watch my live executions, I measure the halfway point or the midway point. So I'm going to do that here for this candle. Now I just want to show you how algorithmic price is, right? I'm going to measure this candle. Now, look at what price does when price comes back down. We tap past the halfway level, but where do the bodies close? And I always mention this. If the bodies are closing below 0.5, we're probably going to go lower. If they're closing above 0.5, we're probably going to retrace up. And that's exactly what happens. Immediate retracement to the upside after tapping onto 0.5. That's another price signature that we're going to move higher. So that there, it's called a rejection block, and it's the whole candle, right? But you use the wick. It has to have a long wick. So that there is what you call a rejection block, right? And I'm going to show you another example later on. If you want a more in-depth video on this, let me know. But that kind of is how you frame it. It has to take out liquidity, and it has to have a really long wick. Price may return to that, but reject from that, as we've seen here, right? We reject from that. We displace past this candle here. That there's an order block. So once we displace to the upside here, that indicates a change in the state of delivery. And once we close past this swing high here, that now represents a market structure shift. So if you're using the ICT model, we've got a rate of liquidity, we've tapped into a bullish fair value gap, we've rejected from that, then used the rejection block to reject further, and we've had a market structure shift, and we have relative equal highs very close, and we're overall bullish on a higher time frame, right? Because we've been heading up for days, so we're going with the overall institutional order flow. So multiple confluences to allow you to enter the trade. And where do you enter from? Right here. From this candle's low to that candle's high, that bullish gap is your entry point. So that busy is your entry point right there. So in terms of entries, that would have been your silver bullet entry for a long position. And that's really all that happens for silver bullet. You may have wanted to enter from here, right? So you could have entered from here, include that volume imbalance. There's another busy. So you've got two opportunities. And I guess the question you might have is, all right, well, if you enter from there, well, where's your stop loss go? Personally, if I was entering from this one, I'd be going as soon as I get into the fair value gap, and I'd place it below this down close candle, right? That's what I'd do. Personally, that's what I'd do, right? Where would I target? 1-to-1, roughly my stops get moved to break even. If you wanted a fixed risk to reward, you could do a 1-to-2. I mean, this move obviously goes up quite high. If you're aiming for like 1-to-5s, you're probably not going to get that. But you can see we do go quite high from that fair value gap. If you entered from this one, where would I put my stop loss? I'd actually put it below this busy or below this candle, because we've already tapped into it just with a wick and rejected from it and displaced higher past these relative equal highs. So there should be no need that price closes below this candle. And then what you could do is, again, 1-to-1 stops to break even, 1-to-2 or whatever you need to, 1-to-3, take your full take profit or take partials, right? But it would have been a pretty quick run to the upside there. So just going through a couple of things, I think it's really important. Rejection blocks are something that, you know, they pop up a little bit now and again, and it tricks a lot of people. So rejection block, market structure shift. We're breaking past this candle, changing the state of delivery. We've got a clear target that we want price to just breach through. We've accumulated for so long. We're bullish overall. And honestly, this is technically like accumulation pockets that later on we're going to target, right, when we start to have the sell side of the curve. So what I'm going to do, I'm going to leave that there. I hope that kind of makes sense, but that would have been your silver bullet trade. If I play this out and you wanted to trade the rest of the London Open session, and I've just had a look at this now, we do take out this liquidity, right? We take that out at about 352. We do have a shift in structure here, but in terms of an actual trade from a fair value gap, let's see what happens here. So it looks like, just looking at this now, you could have entered from this one here, but let's have a look, right? So is that a good spot to enter from? And here's what I do if I'm gonna like consider that. I get my Fibonacci, and I go for the most recent price swing. Roughly the most recent price swing, right? You just want to get that price swing, and then what you want to do is look at where 0.5 is. So technically anything at 0.5 or above is valid to enter from, so you could do that. And it could be a fair value gap that you could enter from here. The question you might have is, well, why wouldn't it return to these fair value gaps? And it could, that's the thing, and it could. So me personally, even though that's valid, I prefer entering trades at the top here. So once you've got a rate of liquidity and a shift, if there was an imbalance here and a return, then I'd enter that one. There's an inversion fair value gap here that you can see. So there's this bullish gap, and we close past it and then we trade back into it. So that could have been an entry as an inverse fair value gap, but it depends what PD arrays you want to enter from, right? So personally, I like to enter at the top. If you don't mind, pyramiding down that far, you can do that as well. With this, the good thing about it is that there's a clear target, because remember we talked about this low here and this low here were relative equal lows. So even though we left those, right, we're going to come back and take those out later on. And technically, like, this is a sell model, market maker buy model, market maker sell model, because you've got accumulation and accumulation pockets. We come up, we come down, and we take out the original accumulation. So let's just play this out a little bit more so we can see what happens here. So notice here, just so you can see again, 1, 2, 3 equal lows. Now whenever you have equal lows or equal highs, they're going to get taken out. It doesn't have to happen straight away, but they will get taken out. And I think later on what happens during the AIM session, we actually do take out those equal lows. So I'm going to play out this chart, and then we're going to actually discuss the AIM session and what actually happened during that session. So we're heading in, we're approaching the 8:30 news candle, and look at what it does. It takes out both buy side liquidity and also this sell side liquidity. So it brings back the market to a neutral or like a balanced state. Now, what I want to do, I just want to get rid of this. I want to go through the second example of the rejection block and go through the trade that you could have taken during Silver Bullet. So that's the London session example. So this is part 2. This is now the Silver Bullet session for New York. Now, notice this candle, we take out this buy side liquidity. So if you were trading the AM session, London highs and London lows, we know they hold a lot of liquidity. And you know we've just taken out here the London buy side. Now, I don't trade just before news. I usually don't trade just after news. I give it a little bit of time to settle. I'm not really trading at 8:30. Usually it's in the Silver Bullet if I was trading the session, and it was within the macro from 9:50 onwards in 99% of cases. But we take out that London buy side, and then what I'm going to do, I'm going to go to the 4-hour time frame and show you the 4-hour fair value gap that I was talking about. So this one here had my attention, right? Because in London session, we came very close to it, but we failed to get there. We tapped into that 4-hour fair value gap, rejected, right? Came back into this one and then rejected back up again. So we're still stuck in this range. We've come up, come down, and then come back up into the range. So that's the 4-hour fair value gap I'm talking about. So generally speaking, when you're looking at liquidity rates, if there's a imbalance or fair value gap above or below that, it's really nice. And that's exactly what I was talking about here in London session, where we took out sell side and tapped into an imbalance. Same thing's happening here, just a higher time frame imbalance. So we took out buy side, tapped into this imbalance. Again, I could measure this imbalance and measure the halfway point, just roughly, so you can see where that candle stops. Right? Notice, and I'm going to zoom in just so you guys can see, this candle's weak. It doesn't even get to the halfway point of that fair value gap. So it rejects from there and closes below. And then what happens? Ends up closing all the way down here. It comes further down, but then closes right here. So interesting what happens, right? And obviously these news events, they're often multi-stage events, right? What's really happening from 8:30 for the next hour onwards, it's just a fake move. It's just tricking people. Like, this is tricking people that the price is going to go up. And what happens is this, again, this candle has a really long wick. It takes out liquidity and taps into an imbalance. So we can use that wick as a rejection block. And again, look at this, the wick taps onto 0.5 and then rejects from that spot. So rejection blocks are good. And that's the only time when you can have some kind of shift. Apart from that and SMT, they're the two cases where you don't necessarily need a rate of liquidity and you could enter from a market structure shift and a return. Now, Entry models here depends on what you trade and the time frames you trade. I know some people have asked me about, market open trades. Well, there is one here technically, but it makes use of an inversion. So this candle's low to that candle's high, and it's an inversion fair value gap. So extend that across, price trades past that, that's where you enter. It doesn't have to return, it still can be used as an inversion. So that there is an inversion fair value gap. Apart from that, there's nothing else here that I like. You would have entered from here, stop loss probably above this high or above this one, targeting these two lows or one of these lows as your liquidity. And here's what I really wanted to focus on, right? This is when we get into what I call fake market structure shifts, right? Fake market structure shifts, which used to be a really big issue for me when I first started. I'd always be looking for reversals, and there's nothing wrong with that. I still prefer taking reversal trades. But in this case, you can see what happens, right? So what I'm going to do, I'm just going to write down the time. It's about 15:20 when we're talking about the fake market structure shifts. And I'm going to put bookmarks on the video. 12:22 was roughly when we moved on to the AM session. And then before that was the London session. So this video might be about 30 minutes. Break it up as you need to. But here's the thing. Again, when I'm trading any session, look at these things, consider these things overall, right? What news has happened on the day? Like when there's red folder news, the reaction to the news, consider macros, right? If you're trading the AM session, consider the 9:30 to 10 o'clock movement, right? Consider any fair value gaps nearby. Consider the new quarter at 10:30 AM. So I'm trying to apply any concept that you might think about if you're trading the AM session or silver bullet. So first one, news. Was there news? Yes. Was it big news? Yes. What happened with the news? We took out London buy side. We rejected from a 4-hour fair value gap, which is a higher time frame fair value gap. That's a pretty big type of rejection, right? So first rejection was here to tell us that price wanted to head lower. 4-hour fair value gap. Second rejection actually came from the rejection block, and it came between 9:30 and 10. Now 9:30 and 10, if you don't know, is called the opening range. I've talked about it a few times, but we've got two times here where the price is rejected from something. Once here and then once there. So that should already tell you that the order flow is bearish now and that we want to target sell side liquidity, right? That's the first thing. Secondly, when you're in a trade and you're looking at silver bullet, because silver bullet starts from here, right? That's 10 o'clock. I think it's this candle. From 10 o'clock, you're waiting for a trade, right? Price just absolutely sinks and then it starts to accumulate. Interesting. Whenever you've got a massive sink like this and you've had multiple confirmations that price might want to head lower and maybe not higher just yet, I'd be very careful about what rests in this price leg. I'd be very careful about what rests there. And what I mean by that is, are there any fair value gaps here? And I talked about this just briefly in my TikTok video, but what I want to do is I actually want to go on replay and just go on the 5-minute time frame. So let's assume, right, and let's just get this back to here. I'm going to exit this and I'm going to go back to that time frame just so we can actually replay what it would kind of look like, and we'll talk through a couple of things I'd be thinking. So imagine you're watching the market, and for me personally, when I was trading the AM session, I'd be watching from here, right? You're watching the market, you're like, oh yeah, interesting, it looks like we're going to head lower. We're probably going to take out this sell side liquidity. So you'd be watching the market and price is, heading down. Cool. Nothing really that I'd take advantage of at this point. Now I'd be curious, right? In my head, I'd be thinking, all right, okay, we've just taken out some sell side liquidity. So a lot of you might have done this. You might have said, okay, we've taken out sell side liquidity. Now I'm waiting for a market structure shift and a return. And I want to take the price higher. Okay, fair enough. What do you reckon this is? And I haven't told you guys yet, but I'm going to show you on the 1-hour time frame. Look at this. On the 1-hour time frame, that there is a fair value gap. Can you see that? A 1-hour time frame, there's a fair value gap, and we're going to talk about that in just a second. So let's go back to the 1-minute time frame here. We've taken out sell side liquidity. It seems as if, right, after CPI, we've just been stepping down. We tried here. We really did, but we rejected again. So we've had 2 rejections. And now I'll just be waiting. Now, Once we get to this point, we start to accumulate. A lot of people at this point would be like, oh yeah, okay, we've taken out sell side. Here is a market structure shift. I'm going to enter a long position from here. And I'm going to put my stop loss below one of these swing lows. And I'm going to target like a 1 to 2 or somewhere around here. Now, the reason why that doesn't work is because of what we talked about here. There's already been 2 price signatures that, you know, the market wants to move lower. We've got a 1 hour imbalance here, right here, and some liquidity on the 1 hour time frame that's very, very close. And in this price swing, again, this is what I was talking about. Whenever you have a massive drop like this and order flow has been bearish, and you can kind of see that, go into a high time frame, ideally the 3 or the 5 minute, even the 15, and look at that fair value gap. Now, whenever there's fair value gaps, I measure out the midway point. Again, this applies here too. So if I measure the midway point of that bearish fair value gap, I'm curious how we close. And if we do close at the 0.5, we want an immediate rejection. So what I'm looking at is how we closed. Now, I'm just going to go back a few candles, right? Look how we trade right here. Look how we trade right here. Look at that rejection. We actually come up and the candle closes right here. At the end of that 5 minute candle, if we go back to the 1 minute time frame, this is what we're seeing. And this would now be your entry point. Not even your entry point actually, if you're going to enter from this fair value gap. So now you've got an opportunity to actually not enter the trade. So you could have seen this reaction and said, wait a second, order flow is bearish because of these 2 rejection points. We've got sell side liquidity down here and an imbalance that we're going to fill. Maybe we're not going up just yet. Maybe we're not going up just yet. And that could kind of save you, right? Because look what happens. We know what happens. We take out that sell side liquidity. We use that inversion fair value gap and we end up progressing lower, right? So there's a few things here to consider when you're taking a trade to not get faked out of the market and consider something a market structure shift when it's really not, right? So my advice is, again, number 1, consider all these things, but number 2, see what price has already done. Has it actually rejected from a really high time frame PDRA? And the answer is yes, the 4 hour fair value gap here, the bearish one. That rejection plus that rejection should be enough to get you cautious about entering longs. And the fact that we just pushed up here quickly, right, into this imbalance here is a bit, you know, it's a bit suspect, especially because look at this, right? How do we actually push up into that imbalance? Don't you see like this accumulation as well? This is really interesting. So here you've got the power of 3, you've got accumulation, you've got manipulation to the upside to fill this imbalance. In doing so, you take out this internal buy side liquidity. Then immediately you reject and you create a market structure shift. That inverses this bullish gap, and that would have been your entry point to go short. Even if you entered at the start of that gap with your stop loss above this high, or even above this fair value gap, and you wanted to target this swing low, it's still a decent risk to reward. And if you order a 1 to 2, you're still going to get that quite easily. And that's still within the silver bullet time frame, right? So I just wanted to kind of touch on that because this pops up quite a bit, especially when trend continuations happen, right? Especially when trend continuations happen. We often move in one direction during the AM session and the other direction during the PM session, right? But here's an example to kind of watch out for. So my advice is this, right? If we've had multiple reactions and it's been a heavy news day and we see a rejection block and a rejection from a higher time frame PDRA, just watch out for higher time frame imbalances. Now, by all means, if we didn't have this accumulation, manipulation, distribution, then it'd be different. So, for example, if you wanted to, right, for example, and you wanted to scalp a position, say there was a market structure shift here and it was a really big green candle to here and price returned, okay, you might enter from there still, put your stop loss below that swing low. And if price disrespected this bullish gap, well, maybe you still get your 1 to 2, right? So if you're a scalper and you want to trade like that against the order flow, that's completely fine. But if you're taking partials in this example and you entered from here, you would only get filled when prices come down here. So there'd be no like chance for profit, if that makes sense, right? If you entered from this top bullish gap and you put your stop loss below that low, I'm just going to have a look here, you would have got to maybe a 1.1 well, not even a 1, a 0.72. So it wouldn't have been enough to actually move a stop loss, in my opinion. You would have had to ride that out, and you would have got stopped out and hit your stop loss. So that's just my advice in terms of managing risk and fake market structure shifts. It's something that got me. It's something that people have been asking me quite a bit, and that's my advice. Whenever you've got order flow that's bearish or bullish, and you're trying to oppose it, if you don't get an entry right here, and if we return to an imbalance before returning to your imbalance, that's a bit of a suspect sign. If we return here first, maybe you can get a scalp into this imbalance and then reduce your risk. But we return here first, so it's very risky because the order flow is bearish. So I hope that kind of makes sense. If you want another video on that, let me know. And I think we're going to continue on with this video. We're going to continue on. It's going to be a bit of a longer one, but what I want to go through now is one more thing or a couple more things. I want to go through the fact that sometimes the AM session moves in one direction and the PM session moves in the other. So let's play this out and let's see what happens at price, because I always used to trade the AM session and I'd get caught on moves like this and I'd be like, oh, I know it's going to go up soon. I know it has to retrace somewhat sometime. But unfortunately, I'd only trade from 10 to 11, and then I knew the lunch hour was at 12 o'clock, right? I knew the lunch hour was at 12 o'clock. So we're going to play this out a little bit, and it's going to be quite quick. This here, by the way, is sell-side liquidity on the 1 hour time frame. This is the 1 hour fair value gap that you can see there. Now the question for you is, are we finding some kind of support in that 1 hour fair value gap? If you answered yes, beautiful. Notice that. Now, the power of 3 occurs on all time frames, and this is an example of PM session trend reversal, which ICT talks about. If you trade the PM session, I know a couple people do, this is what I'd be looking into. Now, have a look at this. You've got this accumulation move here in blue. Where's the manipulation? What does the manipulation do? The manipulation here takes out that 1 hour sell side liquidity, and in doing so, it fills this 1 hour bearish fair value gap, or bullish fair value gap, sorry. So I'm going to change that to green. And then the distribution move is now to the upside. Now, if you get rid of this, because we're already seeing what happens here, accumulation, manipulation, and then distribution to the upside. Where's your market structure shift and where's your return? Depends what your class is market structure shift, but essentially we're using this bullish gap to move higher. This bullish gap. Now, do I encourage you to trade during that? Not really, because we're heading into lunch hour. Personally, I don't really like trading in lunch hour. But you can see we use this gap, we tap in this order block, and we progressively move higher. So this is a really typical example of AM session trends in one direction, PM session trends in the other direction. And I guess here you'd be curious about where you could enter a trade from. Is there an opportunity? Well, let's have a look. Silver bullet, 2 till 3. Let's have a look what happens here. Not really. If I have a look, 2 o'clock till 3 o'clock, not much is going on there. So this would be not tradable in my opinion. The only entry would have come down here, which is in your lunch hour, which a lot of people don't trade. PM session, let's play that out too, to the end of PM session, just so we get a bit of a picture of what's happening. So PM session, the rest of PM session, even the macro from 315 to 345, nothing really happened there, right? Nothing really happened there. But what you can see here is AM session trended one direction, PM session trended the other. And you'll notice this many times. Sometimes, unfortunately, it's actually the lunch hour that performs the most, right? Some people trade it, some people don't. And sometimes you'll see silver bullet windows or macro windows, they don't deliver like you want them to. So my advice is stick to something that makes sense for you, stick to a time frame that makes sense to you, stick to a session that makes sense for you. And if you want more examples about this, let me know, right? Let me know. So that's almost going to be the end of the video. What I want to chat to you guys about is obviously the Discord, and that's going to come back up this week. So I'm thinking on the weekend. I've been tweaking a few things. Now I'm in the development of making a few PDFs, and let me know guys if you'd be interested in these, right? So I've got to think about doing PDFs, right, that incorporate a bunch of things. So for example, I'm just going to get one up here so you can see something like, and I'll just show you guys this, something like this, and let me know your thoughts, right? So just small PDFs talking about different concepts. This one here is about liquidity. I've got another one here which is about time and price, right? So if I just scroll up here so you guys can see time and price, time of day, macros, quarterly theory, examples of that too, right? So let me know if you'd be interested in that. I'm thinking of making some kind of package that I can give out to you guys. And obviously you guys have seen the other two already, like you've already seen this one here. We talked about this. Now, technically this PDF here is a trend continuation model, which technically shows what happened here. It's exactly what happened here. So if you look back to this one, that's exactly what happened here. Exactly the same thing, exactly the same thing. Overall bearish trend, right? It looks like that's a market structure shift, but in essence, we just raised some buy side liquidity and we tap into a 5-minute fair value gap and sell off. Exactly the same thing happened here. So